Hello, Eric.
Morning, Ed.
Jackie, just press your video on. Well, we have a really, really nice audience today, so we want to thank you for taking some time out. There's so many things going on that we're going to ask you to spend the rest of your day just with us on this conference call, discussing all the interesting things that are developing. But now we'll try to put it all together in half an hour for you in terms of our latest thinking. Jackie's joining us today. She's constantly writes very interesting uh, materials on sectors, on technology, and all kinds of important things. And so I'll ask Jackie to jump in a few minutes to discuss what's going on with the healthcare and energy in the incoming administration. And then, of course, we've got Scott Bessent coming in, and Eric's been writing about that today for tomorrow. So we'll give you a little heads up on how we're seeing things. And meanwhile, before I forget, let me wish you all a happy Thanksgiving. I always call my kids a day before their birthdays. And they said, Dad, it's not my birthday yet. It's tomorrow. I said, yeah, but that way I won't forget and I'll get credit for it. So so I'm wishing you a happy Thanksgiving at the beginning of the program. And I'll try to remember to do it again at the end. But have a great time with your family, friends. I think just about everybody agrees it's one of the better holidays. It's all you got to do is eat. You don't have to bring any presents, and you get to enjoy things. So I guess in some families there'll still be some discussion of politics, but maybe everybody will just give it a rest and enjoy it and have a good time and hope that the country is on the right course for all of us, not just for half of us. Uh, Certainly looks as though the stock market's drinking the Kool-Aid, bought into it, which is great. Maybe it's more like eggnog. We shouldn't be talking about Kool-Aid this time of year. So the stock market is drinking the eggnog, and even the bond market seems to be happy today because of Scott Bessent. So maybe the Santa Claus rally is here already. It seems to have been here for quite some time, but this is the official season for the Santa Claus rally. And on top of everything else, the usual rumors about a possible ceasefire between Hezbollah and Israel. That would be a good thing to cap things off. And of course, it would be good to get things settled in Gaza as well, and between Ukraine and Russia. But who knows? Trump is moving fast. I don't get the sense that he's spending as much time twittering and kind of lambasting and giving speeches. He seems to be really working pretty hard here to put together a cabinet that half the country will probably love and half will probably hate. But hey, let's give him a shot, and again, hope for the best for all of us. Um, the the issue of the cabinet members is something that we do want to get into. Eric, give us a quick rundown of why the market, including the bond market, is so excited here. I mean, it looks like Trump kind of listened to what we wrote just this morning, that Trump has to placate the bond vigilantes. He keeps quoting about how the stock market's doing great, but he should really be watching the bond market. And today he's got it working in his favor.
Yeah, the 10-year is down 11 or 12 bips this morning, below 4.3%. And we've been talking a lot about how, stronger economic growth and maybe higher inflation expectations have driven long-term bond yields. But clearly some of that was term premium or just concerns about the fiscal deficit. And it appears the bond vigilantes think Bessent is the man for the job. His kind of overarching plan that he pitched to President Trump was this 3-3-3, kind of like a Shinzo Abe three arrows type plan. It's for 3% real GDP growth, budget deficit that's 3% of GDP, so half of the current 6%, and then producing an additional 3 million or so barrels of oil. The Treasury Secretary doesn't have control over all of those, of course, but it's definitely something that I mean, to us makes sense, and we think it's plausible, and obviously would be good for cleaning up the fiscal picture and for getting the economy on the right track. In terms of the bond market too, it's interesting. Bessent was very critical of something that we've called out, which is that Janet Yellen really flooded the market with bills and funded a lot of the deficit over the past year with T-bills, rather than risking, issuing long-term bonds and upsetting the bond vigilantes. Bessent has specifically called this issue out and said we need to term out the debt. We can't rely on bills. It's not a prudent way of managing the U.S. Budget and fiscal supply. Yet the bond market is still, taking him that he's a steady hand, and the 10-year yield is falling much more than short-term yields. We actually have to get back to flat.
Eric, that's really pretty incredible when you think about it, that he's telling the bond vigilantes, I'm going to stuff more bonds into the auctions.
Yeah.
The bond vigilantes are saying great, and so it's clearly the focus on the deficit and getting economic growth high enough, and dealing with the debt in such a way that the debt to GDP ratio comes down. At least he's talking the talk that the bond folks like to hear. And I think before the election, the complaint was neither side was addressing the deficit whatsoever.
Mm-hmm.
And now all of a sudden we've got Doge with Vivek and Elon ready to cut some spending. There's been previous attempts to do that, but not very successful. So we'll see if they succeed. But if nothing else, I think with Bessent and with the Doge, Trump has bought some time, and the bond vigilantes maybe won't be saddling up on the attack here. And obviously, the stock market likes that quite a bit. Jackie, you've for Thursday, you did some really interesting work on the incoming administration with regards to healthcare and energy, and you did from the get-go mention that RFK is well, how can I put it? Kind of a bit of a strange dude, but he's got some interesting ideas. You want to kind of give us your spin on it?
Sure. Basically, we just looked at the idea that he's sort of tagged as this vax doubter and therefore considered somewhat crazy. But if you sort of back away and you look at what he's saying, it's broader than just that. It's the idea that there are all these chronic diseases that seem to be plaguing kids these days. So, he's 70, and I'm certainly old enough to remember a time when, you didn't have kids, or perhaps the number of kids that have sadly autism today. And you didn't have kids with tons of peanut allergies who couldn't, have snack at school, or had who had diabetes or eczema. And so, in the bigger picture, what he's trying to say is we need to get at the root causes of these things. And, whether that be vaccines or whether that be chemicals in our foods, it's a subject that deserves further investigation.
How was Dr. Oz fitting into that whole effort?
Well, he was nominated as well to be head of Medicaid and Medicare. And then Trump subsequently also nominated a whole bunch of other doctors to be head of all the other different agencies, the FDA, the CDC, the Surgeon General. They're all actual doctors, which, is reassuring to benefit or help out Kennedy.
Yeah, so the doctors' lobby shouldn't have much to complain about, but I guess we'll see. One of the areas where there's a tremendous amount of cost is in social welfare programs, particularly healthcare, Medicare, and Medicaid. So I don't, it's way too early to tell if either one of them has any game plan for figuring out how to make that whole sector more efficient and work better. I mean, Vivek and Elon are basically focusing on getting rid of waste and fraud, but actually getting into the operations of the healthcare system and where there could be some efficiencies is a whole nother ball game. So we'll see. Anything you wanted to add on that, Jackie? How about before we move on to energy?
No, just that there's something like 80,000 people that are working for HHS, and the budget is something like $3 trillion. So there should be ample opportunity to find places to cut.
Yeah, I understand some people in the bureaucracies are having counseling sessions. They're very distraught by. I guess they're figuring they might lose their jobs, so we have to kind of commiserate with that. That's no fun thinking you're might lose your job. But tell us quickly about what the incoming energy story looks like.
So the guy, Chris Wright, was nominated to head up the energy department, and he comes from the fracking industry. He was sort of a supplier to the guys who do the fracking. And so, the expectation is that Trump will make it easier for people to drill, baby, drill. And that he'll, either what he'll probably do is make regulations easier or decrease the number of regulations in the industry so that these guys can drill more oil and gas. And people think this will be a good idea, but the potential problem is if more oil hits the market, which is already oversupplied, could oil prices go down? Conversely, Trump is expected to increase the amount of gas exports, and that could decrease the amount of gas available for domestic use, and that could send, or that already has sort of sent natural gas prices higher.
But I think the game plan is to get energy prices to either be flat or to go down, because clearly energy is such an important driver of the overall inflation picture. And so if they succeed in doing that, that's sort of their response to the question of what are you going to do on the inflation front? What are you going to do on the price front? Again, the inflation story, Eric, is pretty complicated now with all these moving parts. We got tariffs. I think they are going to go for 10 to 20%, but we'll see whether Scott Bessent, what his take is. He seems to be more of a moderate in terms of how you implement these things. So I don't know that it all happens at one time or gets phased in. But we did some work showing that if you take total imports of goods and services and multiply it by 10%, you get about $400 billion in revenues at an annual basis. If you take it up to 20%, you get $800 billion. That's a simple math. The reality is, well, you raise tariffs like that, you might actually import less. You might kick off a trade war. So there's a lot of things that could happen. And while we don't think 10 to even 20% on imports necessarily is going to show up in a major way on inflation, we don't know for sure. And so it's a concern. But if that's offset with flat to down energy prices, then maybe it all kind of works out. Eric, any additional thoughts on the inflation implications of everything we're talking about?
Yeah, I mean, I think I think he views tariffs primarily as a tool for like economic statecraft. And if you think about the way in which he's described the positive implications for trade partners, it's saying, okay, you're going to be subject to these, but if you practice fair trade and you align with us, think about like Western European countries, NAFTA, etc., like then we will have really favorable terms with you. So that might crowd in more defense spending from European countries, which have basically relied on US government defense spending, right? So like that's a way in which we cut federal spending and we encourage the rest of the world to do their fair share. That's not exactly inflationary, right? So it's not just let's slap tariffs on the rest of the world and just try and increase revenues. It's let's try and like get rid of some of the deadweight loss and actually improve our share of globalization. So it's not so simple to do these really easy calculations, which are kind of floating around the sell side
Sure.
idea.
Sure. I think with regards to you, Jackie, I guess one of the concerns I hear is that government employment has been a source of payroll growth over the past couple of years. And if now we see some of the healthcare, you said 80,000 people. So if you start cutting back some of the employees there, that would have an impact on overall payrolls. What's missed in that analysis is the increase in government payrolls over the past couple of years has not been at the federal level. It's been at the state and local level. So that doesn't mean that, we couldn't see federal employment going down, and that would weigh on overall payrolls. So the bottom line of all this, my good colleagues, Eric and Jackie, is this sounds like the roaring 2020s, doesn't it? I mean, we're talking about drill, baby, drill, pumping more oil, keeping a lid on energy prices, maybe on balance, flat to down, 3% real GDP growth. We think that's doable with productivity, and it might be even better than that in our roaring 2020 scenario. And then we've been of the opinion that we'll worry about the deficit when the bond market worries about the deficit. Well, it's been only one day, but the Bond Vigilantes got to vote today, and their vote today was we kind of like what we're hearing, and the idea that we will address outlays, we will address revenues, and at the same time we'll aim for more growth. That all sounds pretty good. So again, the roaring 2020 scenario, which we give a 55% probability to, looks like there's no reason to lower that probability. Maybe some reasons to raise it, but certainly not lower it. And on the other hand, we're still very comfortable with 25% for a kind of 1990s style melt-up situation. A bit of irrational exuberance. We're certainly seeing it not just in the stock market as it broadens, which is a good thing. Seeing it in areas like Bitcoin. Eric and I wrote a brief piece on Bitcoin last night, and maybe some of you saw it this morning. And our take of it is that Bitcoin is kind of like digital tulips. And we don't mean that in a critical way. We mean it as sort of a model for thinking about what Bitcoin is. The tulip mania was just in Amsterdam, and the market was only open during the day. And once everybody, all the speculators had bought their tulips, then there was nobody else to sell it to. It kind of all fell apart. In the current situation, the Bitcoin tulips, those are for sale 24/7 on a global basis. And there's certainly plenty of potential buyers still out there. And of course, MicroStrategy, is that their name, Eric? MicroStrategy, did I get that right? Give us a quick take on how that works. I don't think it's a Ponzi. I don't think it's a scam, because it's right there in the light of day. It's totally transparent, and I think I like the model so much. I'm thinking Yardeni Research should do it. So give us. You may be in charge of this. Go ahead, tell us.
Yeah, it's kind of interesting that MSTR trades at such a premium to its Bitcoin holdings. A lot of people floated the idea of short MSTR against long Bitcoin because there shouldn't be that gap. But the way the Michael Saylor, their CEO or whatever he calls himself, does it, he uses at the money financing, uses equity, debt, converts with no yield to just get financing and purchase more Bitcoin, thus driving up the value of his current holdings. And it's like a perpetual money machine, essentially. So when does it end? It doesn't look like it's today. Supposedly this would come crashing down, but it doesn't appear to do so. I mean, you can also think of Bitcoin like when we talk about gold and central bank demand, especially from some of like the pariah states like Iran, China, Russia. Is that gold used in an illicit way? Like perhaps, right? But that doesn't mean like other people don't own gold. So if Bitcoin is acquired by these actors to diversify their holdings, it's used as a means of payment and transacting. I guess it keeps going up. You know what I mean?
Yeah. It's I got an email from a believer, and that while we kind of concede we don't know how high it can go, but we're kind of skeptical about the validity of the whole thing, because we're kind of old-fashioned strategists to value assets. We like to have quaint things like dividends and interest income or rent, and there's none of that with Bitcoin. But this advocate of Bitcoin as a permanent feature of the landscape, and it probably is the way it's going. is that it's digital gold. It's not digital tulips. It's digital gold. And because there's only 21 million coins, I always thought that the idea that there was a limit to how many Bitcoins there would be uh, didn't make much sense because you got all these, I don't know, hundreds, thousands of other cryptocurrencies that have flourished. So it didn't seem like there was a shortage of cryptocurrencies. But if the majority of people agree that Bitcoin is kind of the founder of this whole movement, maybe it will continue to go higher. But there's just something very peculiar about a situation where you set up Yardeni Research could go public, borrow money in the convertible bond market at no cost, and then issue equity, and then go ahead and buy Bitcoin enough to drive the price up, and then our stock price goes up, and then we raise more equity and more debt. I mean, it's maybe we have found something miraculous here, but as I said, it's global, so you have no idea how long this carries on, and it could be a hell of a roller coaster ride. I mean, it could certainly take a dive as it's done before, but I think what's going on now, it's been legitimized to a large extent. I mean, the president's on board. He once called it a scam. He doesn't call it a scam anymore. So it may very well start having some macroeconomic effects. I mean, might it make so many people so rich that it kind of creates a wealth effect and therefore an inflation effect that suddenly forces the Fed to raise interest rates? As you said, none of this is going to happen today. Nothing dramatic has changed in that regard, but we'll be watching it. I think in lieu of flipping through the slides are fairly well explained in our morning briefing, and they're mostly about the government deficit and revenues and outlays. Why don't we, Eric, go and take some of the questions? Looks like we've got a nice big audience today, and they got some questions.
Yeah. So first one, Ian, great to have Jackie on today along with Eric and team. Thank you, Ian. And we'll go to Cagdis. So hello, Ed. Two questions post Bessent appointment. One, what would be your 10-year yield range now between now and year end versus prior? And then with him as Treasury Secretary, does it increase the odds of a melt up before year end?
Yeah, we we have to admit it's been sort of a moving target for us, much more so than than equities. But I think we basically got it right, especially since the summer, with the notion that the bond yield has normalized, and normalized being where the bond yield was before the great financial crisis. And before the great financial crisis, correct me if I'm wrong, Eric, is basically 4 to 5% was sort of the
Yeah.
wide range we were in. And we think productivity is boosting economic growth. And if that's the case, then the so-called magical mystery phantom neutral Fed funds rate is not 2.9%. It might actually be more like where we are right now. And so, again, we think rates have normalized. So I don't know that I'd change it, Eric, 4.5% plus minus 25 basis points. But
Yeah.
the bond market's responded favorably to today's news, and there's still lots of news up ahead for as long as they don't put us in a box and carry us away. I mean, I'm going to keep doing this. I hope the rest of you are too. It's a lot of fun. It's very interesting. But the issue with regards to the bond market up ahead here is not just the overall outlook for deficit financing, but also how things get timed, what the phase-in periods will be, and then of course there's always the inflation issue. And while we've been optimistic on inflation for the past several years, now that we're pretty close to 2%, we are observing that there's some sticky components to it. Everybody's expecting rent inflation to come down, and it seems to be somewhat sticky in some other areas like the supercore. I want to take another one, Eric.
Yeah. Can you talk through the logistics of tariffs, including who actually pays for them?
Go ahead, Eric. You want to say a few things?
Yeah, I mean, ostensibly, right? Like the tariff is enacted, and then the importer passes that through to customers. So that's the stereotypical U.S. consumers will pay higher prices. The counterpoint is assuming the exporting country's currency weakens. So let's say it's China, their currency weakens, whether it's they do that on purpose or it just happens because the dollar strengthens. Therefore, that country pays for at least part of the tariff because the stronger dollar increases purchasing power here. We saw that to some extent during the first round of tariffs under Trump 1.0. I think it's a mix. It's something that Bessent has talked a lot about. And there's a kind of debate over whether Trump is strong dollar or weak dollar. Strong dollar to start, weak dollar during the middle, and then strong dollar at the end is one way it could work. But I think you have to kind of parse out how much is actually passed through to consumers versus how much do they benefit from a stronger dollar.
Yeah, I mean, if the currency doesn't change, then the 10 to 20% tariff is a tax that American consumers pay, and arguably the burden of that is on lower wage consumers. So that is something to be concerned
Mm-hmm.
about. But as you said, the Chinese might very well respond by letting the currency depreciate, and that'll offset some of that. Go ahead, Eric.
Yeah. We also do like not import that much. We're a fairly self-sufficient nation, which is good to mention. This is from Lucas. Hey guys, I got a January 2024 letter from Key Square, Scott Bessent's hedge fund. This morning, he mentions Dr. Ed. He seems to be in your camp of the roaring 2020s. And my question is, are we close to the I'm so bullish that I'm bearish? It is hard to find bears out there these days. Yeah, I've actually seen this note. I'll read real quick where he mentions it. So he says, economist Ed Yardeni believes that post-COVID America has the potential to have a boom similar to the roaring 2020s of a century ago. We believe that a returning President Trump would like this to be his legacy. And in this scenario, the greatest risk factor, in our opinion, would be a sudden rise in long end rates. So yeah,
Well,
it's squares with us.
that's news to me, and obviously pleased by that. I'm going to make a nice big poster and put it in my office. I like that. That's great. Thanks for the heads up.
Yeah,
So
I
so
just
so our key candidate for the Treasury to support our Roaring 2020 scenario, we got him in. Oh, by the way, speaking of emails and this administration and all that, I haven't seen it yet, so this is hearsay. But I got an email that Larry Kudlow, who I'm professionally friendly with, he's a great guy and he's friendly with a lot of people. But Larry Kudlow apparently was on one of the TV shows being interviewed about what some of the plans might be for dealing with the deficit. And again, this is hearsay. I saw it in the email. I didn't see it yet. We're looking for it, but apparently Larry said that they're working on seeing whether they can just sell a lot of leases. That the government has a lot of resources that they could lease. So maybe it's going to get the environmentalists upset. But they were talking about raising a couple of $1 trillion a year on leases. So that's sort of a new wrinkle. Go ahead, Eric. Do we have one more question or a couple more questions? Meanwhile, I think Max wants to. I don't know. Maybe you saw Max joined us here, but he wants to leave. So go ahead, take the other question.
Yeah, here's one. What's our expectation for PCE on Wednesday? Yeah, I think it kind of follows CPI and PPI. CPI was hotter and hotter than expected. And then PPI has this quirk where basically the rising stock market influences portfolio management fees, and that will flow through to PCE. So yeah, I mean, it's probably going to follow those two and just show that inflation is kind of getting stuck around 2.5% rather than down to 2. And then the Fed fund futures curve has already kind of priced this in. Like there probably aren't that many more cuts left to go if the Fed does keep cutting. But yeah, I don't know if that's not priced in yet. I think the market's pretty ready for that.
Yeah, I mean, at some point the Fed has to model this. I was fascinated that in his latest press conference that the Fed chair said a few times that they haven't modeled the incoming administration's policies yet because they don't really know what they are. But the bond market certainly has been modeling it. The stock market's certainly been modeling it, and you know, our critique of the Fed since September is that they basically promised to be lowering interest rates quite a bit, uh, and not factoring in that there was an election coming, and that maybe they shouldn't make any promises. Give us a quarter, and then say, well, we'll see how things unfold here. Kind of wink, wink. Let's see how the elections turn out. But no, they almost pretended as though fiscal policy is irrelevant, and it's all about the neutral federal funds rate, without conceding that the neutral federal funds rate is can't be measured, can't be seen, can't be touched, and it might be volatile. So it's kind of a useless concept, and everybody agrees with that. There's no doubt about that. But Fed officials are kind of all over the place. Jackie, I don't know if you had a chance yet, so I'm not putting you on the spot, but Jackie, I've asked Jackie to look into the whole energy question with the administration aiming to pump more oil. So we've seen some articles along those lines. On the other hand, there's a concern that just because the administration provides more leases and things like that, the economics of it may not be justified. But I also sent Jackie a note about another article that said if the industry has become so efficient that with their technologies, that maybe their cost of production's going down, and they keep drilling even with the rig count being down. Any preliminary thoughts on that, Jackie, or are you leaning one way or the other? Or?
No, I think you can expect companies to keep pumping oil if they make a profit. I mean, it's sort of an economics thing. So I think the bigger benefit that Trump could provide is if he reduces some regulations and helps them increase profits on each barrel of oil they can pump.
Yeah. Again, one of the accounts I visited recently said that he believes, in the article that he referred us to, pointed out that probably one of the most productive industries in America today is the energy business. The way they figured out how to drill without actually, how to take advantage of holes that they already have started without necessarily increasing the number of rigs. Well, with that, I want to thank everybody for joining us. Once again, I'll say that on our behalf, we always thank you for joining us on Mondays. Thank you for supporting our research, and my 5 kids who I always have to provide a little bit of extra support for. So thanks for that. And we'll see you again next week. Eric, thank you. Jackie, thank you. And see you all soon. Have a great week.
Everyone.
Happy Thanksgiving.